Yeah, Josh, we're talking about the weaponization, I think, of Iran's production as well as exports of oil, which strikes me as strange, right? Because you were referring to that journal report that Iran helped Hamas plan and perhaps even helped to fund these attacks. As a major oil producer, I mean, right now we're at 87.78 on Brent as we speak. It's just a little under 4% ahead. I remember just a couple of days ago we were up at 95, right? That's the year high for 2023, and that was that was before these Hamas attacks on Israel. So, given what we've been talking about, how Iran could get drawn into this and get directly impacted, don't you think 87.79 or that 4%, near 4% move is really underpricing how bad things could get?
Yeah, so I think there's been sort of a head fake in the oil market since the start of October, where there's been this one in particular bad weekly EIA report showing a huge drop in U.S. gasoline consumption. And I think that number is just wrong. And we actually had a similar issue a year or so ago with EIA numbers around also U.S. gasoline consumption. And there's some technical aspects to how it's calculated, but it looks like there was a sell-off sort of ahead of those numbers, which raises questions about who saw those and when did they see them ahead of their publication. And then there was a further sell-off after their publication. And so I think there's sort of this almost false narrative around demand collapsing. But when you look at global inventories and you look at alternative data sources like Rystad or GasBuddy, I mean, you see that U.S. consumption of gasoline, not as measured by the EIA, but actual driving and burning of gasoline by motorists is actually pretty healthy. So I think there's a risk in the way the EIA measures these things that this continues for another, let's say, 2 or even 3 weeks, where there's this continued narrative of demand destruction and economic weakness, and particularly affecting oil. And then when you think about that in contrast with the really strong jobs numbers, and again, not that that number was perfect either, but in the contrast with those really strong job numbers, it just doesn't make sense that you would see U.S. gasoline demand down. And then again, when you look at the global figures, they're actually not bad. So I think we're in this sort of mini negative news cycle for oil, and then you have this positive for oil, again, terrible humanitarian geopolitical event. And so you're sort of seeing these two things combat each other. And I think what this really reminds me of, it's not the 1973 surprise attack on Israel, the Yom Kippur War. It's actually the missile attack on the Saudi oil production and processing installations. I think that was in 2019 or so. And that was a period where there was oversupply in the market, and there was an initial price move up that was pretty significant for a couple of days, and then oil reversed back and started to fall actually pretty materially. So I think there's a risk that we see that, except this time there's not actually that real oversupply in the market. And so I think as those EIA reports start to get revised, to start to show up in monthlies rather than weeklies and then get revised, as well as there's further confidence in some of these alternative data measures, I think you start to see this undersupply and sort of healthy oil market narrative reassert itself. And then, like we just saw with the Saudi energy minister, OPEC Plus is pretty cohesive here. And I think they're pretty set on seeing a stable, relatively high oil prices. And so I think there's pretty good support both fundamentally and from OPEC Plus to get us back. But I think it might take a little bit of time.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.